I believe that office is probably going to suffer the most pressure of all the asset classes in the long term post-COVID, but office is not going away. Companies are going to rethink how they're going to work with people in the office versus out the office. This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odum and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odum, along with Steven Silverman. Steven, slowly but surely, people starting to make their way back to the real world.
They are, and this episode's a little bit different from us. Usually we have a really informative guest to come on and educate us in some form.
Instead, they have us.
And today it's us. We're just talking because we're real estate brokers. We're out and with boots on the ground, and we see and hear a lot of things. And so we thought we'd just give today a 30,000-foot overview of what we're seeing happening in commercial real estate and where it's going.
Actually, we speak with a lot of people. In fairness, folks have asked us to our opinion many times on the various asset classes and what we think is going to happen post-COVID. And so we're going to do a little bit of an overview of each one of them, what we're seeing so far. And listen, this will be a little punditry here. And I'm not on Fox News or CNN for a reason, because I'm the worst at punditry. Steven, but I mean, I think that the discussion and some of the points that we bring up and that some of the things we're seeing, I think could be relevant for folks on how to go forward and what may or may not be opportunities.
Well, especially we're hearing you talk to two different people and you get totally polar opposite views, but just talking to a lot of people, we get something of a consensus. And so, right off the bat from a 30,000-foot level, I would like to give my thoughts that commercial real estate is not like the stock market. It doesn't change overnight, but there are trends in place and mega trends that will have some effects. And our conversation today is, to what extent will they affect us?
Well, before we get into the conversation, let's talk a little bit about reviews. We love reviews. They help us with guests. Google Play and the iTunes Store. If you have not done so, please make your way to one of those two apps and leave us a review. If you can't find them, you can look on our website at the investfloridashow.com, and you can find where you can click on and leave reviews. It really is helpful. It sounds self-serving. It's not. It's really for you guys, guests, potential guests that we work really hard to bring on the show. They want to see that people are participating. And when you guys leave reviews, it encourages them to know that it is an hour or half hour worth their time to come on the show. So if you've not done so, we ask every episode to please go on and give us one. If you've not done so, or if you've done so already, we appreciate you, and we appreciate the fact that you went on and did that for us. Stephen, are any other housekeeping items before we get rolling into our discussion on the various asset classes?
No, I think we're ready to go.
Okay. Let's talk about retail first. I think retail is one of those classes that if you cannot pick up the newspaper, or whether it be commercial real estate related newspaper or any of the mainstream media, and talk about the demise of retail, that it's just going to hell in a handbasket. Give me your thoughts on retail, Stephen. Like, what are you seeing?
So first of all, just again, as a 30,000-foot overview, every night I watch the news and there's always an add-on for car advertisements, and their whole goal is to get you into the showroom to test drive. And this coronavirus has been the biggest experiment we've ever seen. in remote shopping and remote working. And it will have long-term effects because there are people who are early adopters who never want to try things, and people were forced to try to do something that they'd never done before. And then it's not so intimidating. So they're more comfortable now shopping online. And we'll get to the office in a little bit. And I think that's a trend that will always be there. The question is, who's going to live and who's going to die?
My thoughts on retail, and this is going to be a trend that is going to flow through every single one of the asset class discussions that we're going to have today. Do not bet against people being people. And what do I mean by that? Is that people are social animals. If you believe that people are going to crawl into a cave and not come out because now they have access to a mouse and the internet, you are going to be wrong. What does that mean? Do not bet against the social. Look at it from a broader perspective. What does it mean to be human? And it's not, the coronavirus the disease is unique, but the situation is not unique. All of these asset classes we're going to talk about at some point or another, folks there was pressure on them for one reason or another, and they always came back to the human element. Retail, for me, you've seen just the calling for demise of retail for I don't know how long. Retail mall is changing. The covered mall, there's no question about it. Anybody who has access to a mall knows that Sears, JCPenney's, all these big boxes, they're closing, and those are ones that were most susceptible to the internet. But the locations usually of these malls are in prime spots. Of course, the ones that are weren't in prime, they're biting the dust. But the ones that are in prime spots, they're not going away. There'll be an evolution, but they're not going away. But when you talk about retail as a broad brush, you're leaving out the street level retail, the neighborhood centers, the grocery centers. Those already moved away from the internet related type of sales.
They're not carrying inventory.
A long time ago. Right. They're
service related.
They're service, they're restaurant, it's hair, it's chiropractors, it's grocery, restaurant, ice cream. Those are the ones off the top of my head. And if you go drive around in your top locations, good traffic counts over 40,000, even through this coronavirus, they're popping right back. As long as there's 10,000 people walking by it in a day or 40,000 cars walking by it driving by it in a day, that retail center is not going to go away. It's just not. And so really when people talk about retail, the demise, they're talking about the covered mall. And the covered mall is not going away either as long as it's in a decent location, which has not really changed in retail, Stephen.
Well, it's
good location.
And, I go back to another podcast we did actually a couple of years ago when we spoke about autonomous vehicles and how even then they were saying how malls would eventually change. And this may just accelerate what was going to happen anyway.
Yeah.
There'll be new types of development. There'll be autonomous vehicles will drive up in a circular fashion, drop people off to do things. There'll be multifamily replacing some of the big boxes. And we've seen it start to happen already.
Yeah, it was happening 10 years ago. Coronavirus has accelerated a movement that was already occurring. It doesn't mean that retail is going away. It means that big boxes were under attack from a different business model, and the ones that are in good location will just change. Now, let's talk about it from an investment standpoint. This is coronavirus related. The restaurants are getting bludgeoned. It's hard to get people excited about going back into a restaurant until there's some sort of mitigating drug, whether it be a drug that reduces the rate of death of the coronavirus or a vaccine altogether. But I can tell you, having 30 plus years in this business, trying to find first and main top locations in retail has been the most challenging part about being in commercial real estate. Suddenly, you're going to have a lot of these concepts again that were struggling, and the ones I'm talking about. These 30-year-old concepts that have been out there.
Well, we're seeing it in restaurants now, like Applebee's Steak and Shake.
Yeah, Applebee's Steak and Shake. These concepts were struggling anyway. The coronavirus has accelerated their demise. But let me tell you something. Steak and Shake, for example, have they have some great locations in their portfolio. And if this is the final nail in the coffin for Steak and Shake, this is an opportunity. Again, if there's 40,000 cars passing in front of that Steak and Shake every day, somebody's going to jump on it, right? And there might be some distressed opportunities, but it doesn't mean that property is no longer viable. And this is what you have to keep your head on a swivel about, and not just say, well, Newsweek tells me, or the New York Times tells me the world's coming to an end and I'm not going to invest in it. There's not going to be opportunities here. Buy low, sell high. It's just, investing 101, Stephen. So,
and again, Eric, what you're focusing on here, you're talking about A-plus locations. But there's another side to that coin where a lot of retail tenants and centers aren't in such great locations. And those are the ones that I think we're going to see some trouble in and faster redevelopment. And I think might see a migration of some of those tenants into the other better locations that have been vacated.
Yeah, that's a fact. I mean, people are going to be upgrading. If they're in a C location, they have an opportunity for an A location, they're going to jump on it. So, look, don't turn your back. Don't sleep on retail. Just think about it from a human perspective and put on your thinking cap where you might find some opportunities. Let's talk about office, which is probably the second most maligned asset class, COVID. Let's talk about office, Stephen.
So there's no question. I mean, again, as I mentioned in the experiment, people for the first time started working with technology and became comfortable with it. And we've seen and spoken to people who talk about the doom of office. But Office and Zoom, Office has a place still. Zoom meetings don't communicate the corporate culture. There are things missing from that. And so maybe a percentage of office workers can work remotely, but offices will still continue.
So, yeah, I mean, and that's from offices are going to continue. Let's talk about what kind of damage in the office space that the virus is doing. And for me, this is the during COVID office market and the post-COVID office market. What are they going to look like? We just recently received new guidelines from the CDC on what to do about office. And those guidelines include spreading people out. They don't want people, the call centers, for example, are the way the call center was structured, that's not going to exist anymore. Not the during COVID process, because the CDC's saying not 6 feet really not even sufficient. You don't want to be cramming a bunch of people in a room. Maybe there's plexiglass that's put in a separation and a barrier. And there's a lot of things that are going to make it more challenging. So I think in the near term, probably for the next year, a lot of businesses are going to make that decision. It's not worth it, because if the CDC tells them that they're supposed to be separating employees, an employee gets sick and dies because they're sitting 6 feet away from somebody who infected them, I think you're going to find a lot of businesses that are just going to say, it's not worth it. And they're going to try to work from home. That's the during COVID portion of it. A year.
Just while you're on that, and during this COVID, the aftermath, there's also going to be a technology change coming on. I was listening to Larry Feldman speak yesterday. He was one of a podcast guest a few years ago. Larry owns and manages several large office properties in Tampa, and he's focused on technology. He's having elevators that you don't even have to touch. You just go in. They'll have masks. They'll have door handles that you don't have to touch. All those things to try and mitigate risk and try and give people a comfort level.
Yeah, and I mean, it's the during and the after are going to be two distinct things. The office market is going to be distressed. It's going to be under pressure for the next year to 18 months. That it would be hard for me to believe otherwise. But post COVID is a separate situation. During COVID, there's going to be, as tenants are struggling to bring their employees back into the office, they're going to decide to give up on it, at least bits and pieces of it. So there's going to be a downward pressure on it. Let's talk about post-COVID, because, again, just like retail, we hear that office is done. Again, the theme my theme that's going to run through all this is do not bet against people being people. We run a shared office space. It's been crushed. It has the meeting space has been absolutely obliterated. People don't want to come in right now. But what we also hear from our clients, they hate Zoom. They hate managing by it. They hate training by it. They hate meetings through Zoom. There's a delay, people stepping on each other during the conversation. There's no cultural bonding. And frankly, we started the shared office space as a reaction to 2008. People think that Skype didn't exist, that there wasn't video conferencing calls in 2010. You're wrong. Skype was there. Microsoft Office had a platform that was okay. It was pretty decent that people could be able to communicate with their employees. And of course, the internet allowed people to do a lot of work from home and do monitoring. People came back to the office because the cultural aspect, the human aspect of the corporations and the organizations were being eroded. Shared office space was that first step back in, but we were running at the highest occupancy rate in Tampa that I had ever seen. So people came back to the office because there is a cultural component. Also, when you're talking about many of these businesses, doctors, teledoc, great. I mean, medicine, they want to do everything remotely. There's no substitute for putting your hands on somebody and being able to look at them, look at their body language. There's no substitute for that. So yeah, there's going to be some pressure it was already moving in that direction to allow people to work from home more and do more interaction by telecommunication. But COVID's not going to be a permanent situation where that's the only means of people being able to conduct business. So I think the point is, I believe that office is probably going to suffer the most pressure of all of the asset classes in the long term post-COVID, but office is not going away. And it's just going to take a little bit longer for it to absorb. Companies are going to rethink how they're going to work with people in the office versus out the office. And there'll be an increased movement towards hybrid of working from home and working in the office. So they're able to continue to build that corporate culture. So the result is going to be less demand for space that there was pre-COVID. And it accelerated a movement that had already been happening pre-COVID, Stephen.
So my thoughts are, I agree with you in the importance of networking, and I think in certain market segments, in the core office areas, they'll continue to be there because they need to network and they have important benefits and access to skilled workers in the areas. But there are going to be some sub-trends, as you mentioned, going on with office. One is there will be people working at home. And I also think we'll see somewhat of a migration to the suburbs where it's less dense and people don't have to commute in. And certain office properties in suburban areas that are well located can turn out to be good investments.
That's an important point that will lead into the next asset class, which is residential and multifamily. Residential and multifamily, you talk about people not wanting to be in dense areas. I'm going to say this in every asset class. Do not bet against people being people. There was a movement towards inner cities and more dense living before COVID. And now we see it. They came from New York to Fort Lauderdale to Tampa to Orlando to be able to get away from the spread of the virus inside of the city and the more segregated suburbs. Florida's going to be a long-term beneficiary for this. But again, it was accelerating a movement that's been happening really post-World War II, that folks from colder climates want to be in warmer climates as they get ready to retire. And so you're going to see a lot of these folks that were in their late 50s and early 60s say, you know what, we're going to do it when we're 65, but let's go ahead and do it now. Young people, they don't care about this virus, Stephen. And they still want to be in a place where they don't have to drive. They want the convenience of living in a city. It might, again, at the risk of I can look like a fool in 3 years on this. But young people, they've shown consistency over the course of time that they really don't pay attention to people even that were 3 years before them. They're going to blaze their own trail. Time will tell whether that's a long term, but my belief is in a couple of years, all those 20 somethings that wanted to be in New York City, they're going to forget that COVID ever happened. They don't really care about it now. They're at the bars right now in Tampa and St. Pete and areas that I've been, packed in like sardines. They don't care about the virus.
Yeah, we went to a shopping mall this weekend, just drove in. We figured there wouldn't be too many people. It was an outdoor mall. There were so many people and so many cars in the parking lot. We left, but in people's minds, it's over.
So residential, I mean, this is, the multifamily folks, the single family folks. We're going to see an acceleration of the migration from colder states into Florida. It's going to put pressure on supply of multifamily and residential. Well, you agree with that?
I agree with it. The issue I'm having throughout Florida with multifamily is that all the development is in the luxury class.
Sure.
People need places to live. That's why residential is always a more stable kind of environment. People always need to be living somewhere. We're not building enough to take care of the middle class. What will save Florida, because we're building so much in the luxury area, is the fact that you just mentioned that people will be moving down, and to them it'll still be relatively inexpensive to what they were paying up in the Northeast. So multifamily, I think, will continue to be strong.
Yeah, multifamily and residential. I believe you're in good shape. There's going to be increased pressure on supply as we accelerate some of these folks coming from colder climates, more densely populated climates. People are looking at the statistics in Florida and that, they're not on top of each other, and there's some room to breathe. And Florida fared better than New York and Detroit and some other areas that are a little bit more packed in. Plus, there's a vitamin D we've talked about as a factor too, and people being healthy here. Let's talk about, are we done with residential?
We're done with residential.
Okay, so the bottom line, I think both of us agree, multifamily, residential, don't sell your assets now. There's going to be increased pressure on your property, and probably a good long-term hold with both multifamily and residential. Let's talk about industrial.
So industrial is the new darling of commercial real estate because there's been a fundamental shift in the way we're working. I mean, retailers that before were selling retail now need industrial space because of e-commerce. And these are traditional retailers like Macy's and others, not only Amazon. Distribution is becoming much more important.
Yeah, again, it's an acceleration of what we've seen already. I'm looking for 2 clients right now to purchase industrial properties. So if y'all have anything out there in the Tampa area, let me know. These are individuals who are, one of them's an internet business and the other one is relying on home goods. He has home goods. He doesn't sell on the internet. He's exporting. But what's happened with both of them, it's kind of interesting. One of them, essentially people are home and he sells parts and components for speakers. And he needs, 10 to 15,000 square feet. His business has exploded because people are sitting home and they're looking at their current systems, their speaker systems and their sound systems. They're thinking, well, if I'm going to sit here watching Netflix for the next 2 months or 3 months or listening to music, I want better quality. So he's had a tremendous explosion of in his business, trying to sell those components. The other guy does janitorial supplies. And of course, janitorial supplies, cleaning solutions, people doing deep cleanings inside of public spaces has exploded, and he's blown out. So both of those are somewhat affected by COVID. But of course, the movement, we've heard it from the Amazon folks and anybody who's internet related, that they have a tremendous increase in demand over the last few months. I'm sure that's probably going to post-COVID, Stephen.
Well, listen, it's not only traditional retail like Macy's that I mentioned, but it's also groceries, where a percentage of people are now buying online. They never have to come into the store. They'll ship out of distribution centers.
Yeah.
And Florida's really well positioned with the opening of the Panama Canal, which now allows much larger ships to come through. The large container ships used to have to go to the West Coast. They'll now be able to come to the East Coast of Florida and unload in certain ports like Jacksonville and Miami, and to a lesser extent in Tampa. There'll be more distribution coming and more need for warehousing.
Well, right. Industrial was already hot. It accelerated a movement that was already there. I expect post-COVID a return to normal demand levels, whatever normal was, because they seem to be ticking up every year. But it's kind of like the snake swallowing the rat. Right now on industrial, there's been an increase in demand, and then it'll return back post-COVID. Let's talk about something that y'all know a lot about, Stephen, because your family owns assets in storage. Let's talk about and I'm not an expert in storage by any stretch of the imagination, so you'll be able to speak more freely on storage.
I guess I'm not either in this whole thing, but storage is really a subset of the industrial class. I mean, it's the kind of asset where people don't have to be socially interacting. They're generally keeping things there that they don't want to throw away or that they need for business storage. It has suffered. There's a certain percentage that are slow paying, but it will be back. I mean, the danger to storage is not really the existing product. To me, the danger is overbuilding, and it's becoming increasingly expensive to build these kinds of facilities. And you have to look in each area at what the square foot of supply is relative to population. In some areas, it's only 3 or 4 square foot per person, and that's great. But in others, it's over 10 foot already, and they're just like sharks chomping on each other.
And you look at storage, and again, it's not my asset class that I have a lot of experience in, but there's going to be a come to Jesus period on the residential side, and not just on all asset classes. Right now, effectively, evictions and foreclosures, the brakes have been tapped. It's not going to be too long in the near future that they're going to be set free again, and you're going to see an acceleration of foreclosures and evictions. And I would think that would increase the demand for storage. Am I wrong there?
You will see some of that, but you'll also see people bailing out of self-storage where their income has been affected, and they'll put it in their garage, or they'll just say, the thing about storage is there's just a whole subset of people who put stuff there, and it's just because it has an emotional tie to it.
Sure. Yeah, they have a $50 item, and they're paying $50 a month to put in storage is absurd. But anyway, that's a model that a lot of people use, and they have some emotional attachment to their things, and they're willing to pay to hold on to it. Let's talk about from a 30,000 foot level, Stephen, because folks are, we hear it, and folks are saying, well, this is going to be just like the last time, and there's going to be some great buying opportunities, and let's just wait and wait it out and see what happens. What are your thoughts on?
Well, I'll tell you what, I want to answer that, but before we get that, just while we're staying with asset classes, what are your thoughts on student housing? I mean, that's something that got really hit below the belt.
Yeah, and the universities are just getting the what knocked out of them. That's an interesting. Again, student housing is not my asset class. I don't have a lot of experience in it. I can tell you what I see. The university's now moving to online. The common theme is I would never bet against people being people. The classroom experience at university, in my opinion, is 10% of what people get out of university. Most of it's contacts and network and the experience. And so for those folks thinking that the universities are suddenly going to go online, nah, that's not going to happen. You're going to be, again, there's the during COVID and the post-COVID. I think 2 years from now, we're going to be back to normal in university with one caveat. The university's tuition has stupidly increased in price since the early 90s, way outpaced inflationary rates. And this is tied in with the explosion of the bureaucracies inside of these universities. And I think there's been a tremendous opportunity to be missed if we get out of COVID and that fixed overhead aspect of the university is not addressed. And there's going to be pushback if people are taking classes online to not pay those stupid prices. And so there's going to be a push and a pull with student housing as a result of how much of this goes online. How do you price this? But you're already at a point of a revolution.
Well, I think there's, to your point, I think there's another aspect of that is that you're going to see more price sensitivity because universities that are already, even if they have the student body and they've got the overhead, it's easy to take those same courses and now market them online where students can get discount prices. Before it's kind of been like medicine. You can go to a public school or a private school, but pretty much within those categories, you have to pay the going rate. I think you're going to see more pricing activity in education.
Well, it's that, like I said, if we don't see some sort of something coming out in addressing pricing in universities, the entire system has missed an opportunity to address the absurd acceleration in the cost of going to university.
So on the subject of people being people and don't bet against people, let's talk a little bit about hospitality. I mean, that's probably the segment that's been hit the hardest. And I think people will be people. They'll eventually come back to the hotels, but there'll be hotels that just don't have the staying power to last. And there'll be opportunities and there'll be turnover in that market.
No question, but probably of all of these, I am the most of the downtrodden asset classes, and I would say retail, office, and hospitality are probably the most downtrodden. I have the most confidence in the speed of those assets coming back. Yes, the hotel operators are in duress, but as soon as there's a mitigating drug, people will rush. They are now. They're going back now. I mean, Disney's
well, it's like I said, they'll come back, but it's been such a devastating drop that there'll be some that just won't.
Weak hands are going to get shaken out.
Yeah, there'll be a shakeout.
Yeah. So I think that's allows us to kind of move in to this is probably the most common question that we get day in and day out. When do you think there's going to be a buying opportunity? And is it going to be like last time? I don't know what your feelings are on it, Stephen, but every one of these downturns is different. You can glean pieces of information from downturn to downturn, but they're not the same. Yes, things are consistent in how they behave, but overall they're inconsistent. Let's talk about the stimulus. Trillions of dollars are being thrown into the market to keep the markets going and not have a depression-like collapse. The Fed and the Treasury both trying to do more than what we saw in 2008 when those markets went down to try to keep the market's moving along. And then you've seen the subsequent also tapping the brakes on foreclosures and bankruptcies. It doesn't feel the same this time. And yes, there's going to be some shakeout, but there's so much liquidity in the market. You see it in the stock market right now. Just the money being pumped in that we might actually have an asset bubble at the end of this on the back end and not a depression in prices in the near term. Yes, we'll see foreclosures. There's a lot of liquidity that's piling up to be able to acquire those assets. But it's, the economy is like a seesaw. And you've put so much weight on one side with all this stimulus. I can't imagine that when we get some normalcy return post-COVID, that is not going to cause an increase in demand for assets and further cap rate depression.
Yeah, well, remember, this is so different from the last Great Recession that we experienced, where a last Great Recession was really a debt-caused crisis. Now, banks are in pretty good shape. There's a lot of money sitting on the sidelines. And I think we're also going to have to look at different asset classes of commercial real estate because they're going to behave differently. And those that are under more duress, there's a time lag. As I said before, it's not like the stock market. It doesn't happen overnight. We have to go 6 months down the pike and see when they've had some difficulty in paying. And I don't think they're going to be all those terrific buying opportunities that people have been touting and which people are sitting in trees like vultures waiting to scoop up. It's just my personal opinion on that.
Yeah, I agree with that. And I think that of all the asset classes, I want to hear your opinion on this. Some of them are going to be V bottoms. Hospitality is going to be a V bottom recovery, I believe. Retail is going to be a V bottom leaving out the covered malls. That's a completely different asset class, in my opinion. There's the street level retail and there's a retail mall, two different asset classes. But the one that's going to be the hockey stick, the down and the really slow climb back up. Office.
Yeah. I mean, office is an adjustment to the way of working, and that doesn't mean I think it's a bad investment. I don't think that at all. I just think that for the next 9 months to a year, I would be extraordinarily cautious in the office market. And the other thing that we need to mention is during this whole period, there's going to be less development. Developments that are already underway are going to take place, but the lenders that I've spoken to are being more cautious about lending for new development. So the effect of new supply coming on the market will not depress values and rents.
Well, there's no question. The banks are very, very concerned, rightfully so, about the current cash flow situation of the borrower, and can they sustain the punches, roll with the punches over the next 9 months. And so we're seeing a lot of trepidation from the banks of continuing towards closure on deals that had already thought were a sure thing prior to February 1. So it's going to be interesting over the next year, Stephen. It really is. The asset class we talked about most cautious is office. The one that I'm probably I feel is going to be the sharpest recovery is going to be the hospitality. Although we're going to see a period of time with the shakeout of some of these weaker hands that just from a debt standpoint aren't going to be able to make it to the end of the year.
Yeah, and retail, I think you're going to be a shift. I do think you'll be, the weaker assets will struggle, but the ones with good traffic flow and visibility will come back.
Yeah, I mean, and there's so many already that were filing bankruptcy or in financial straits prior to February 1. And beyond, if you're a retail buyer, if you're bullish on retail, right now they're low-hanging fruit. And so I would start getting my list together today of those distressed retailers of what might be an opportunity for you between now and the end of the year. So, now's the time to start, getting the cavalry together and seeing what's out there, Stephen. Is there anything else we want to talk about before we let people go? So
after all this, Eric, we have to ask ourselves a question. So what the hell do we know? But it will be an interesting year coming forward. I think the only thing that we'd like to ask is, we're all in uncharted territory. If people have any comments, and let us know what your thoughts are and what your experiences are, where you think you might see opportunities. We'd love to hear about that.
Yeah, and I mean, we're by no means the keepers of all information in the market. We only take in information from our listeners and from our clients and from banks and our other contact points, and we process all those points and then act as basically we form our own opinions and summarize some of those sentiments. Every time you get engaged in some sort of punditry, which we just did, you have a chance to look like a fool. So it's going to be interesting at the end of 2021 to see how right or wrong we were on our predictions, Stephen. But it's all part of the process. We are in uncharted territories. That the stimulus and the debt situation that's really occurred over the last few months is a wild card here that I might be completely off base, and it might cause some serious problems. Certainly for the long term, I'm concerned about the fact from a fiscal standpoint there has been no restraint recently, and not just COVID related. Prior to COVID, I mean, I've been proven wrong. But a fiat currency without any financial responsibility, I think, it is eventually a stress point.
Well, traditionally now in this last period, going towards a presidential election, I mean, that's when you would see like strong markets and things, and it's just a whole different era now. But we're always out there wanting to learn, and we hope people learn also. And just wanted to remind you to go to our library, the www.investflorida show. You can also download the app and listen while you're mobile. There's a lot of good information out there.
www.investfloridashow.com.
Oh, yes.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odum and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.